now let's connect with Sandip Agarwal, the fund manager at Sowilo Investment Managers. And Sandip, hi, good afternoon. Thanks so much for joining us on ET Now. First of all, give us your take on what you are making of the overall Q3 earnings season. What's your outlook going ahead? And has it been as bad as the street was expecting it to be?
Hey, hi, good afternoon, and thanks for having me on the show. So, if I have to see the earnings season to start with, I think the earnings season has been broadly in line. I won't say that there were much of disappointment. Honestly speaking, the number of results which have come, most of the results are broadly in line or slight. There is a slight miss in some of the cases, but not any big miss, except for some industries where a lot of dependence was there on the government capex. On those industries there have been some misses, but broadly otherwise numbers have been in line, because it could be two reasons. Because from last few months analysts have been cutting estimates, so from that perspective most of the deep cuts which were expected have already happened. So we are not seeing any big negative surprises in the numbers.
Seeing negative surprises in the numbers at least. And Sandeep, we also believe that most of the major events are now behind us, and now the focus will once again shift back to the growth numbers. But talking about the recent fall, Sandeep, it's been quite a carnage in the small and mid end of the market. It's been almost a 20% correction on the index level from the highs. Help us understand that in the past couple of months, have you gone ahead and deployed a fresh money in any of the sectors that you feel are giving some good opportunity at this point?
So, this 20% correction looks little high if you see as an overall thing, but at the same time, we always have to see the fall from the top, and also what was built in. So I think a lot of excesses was there on the upside also. And I think with the current recent correction, a lot of sanity has returned into substantial number of large and mid cap stocks. We have become very aggressive on the private bank side since last 1.5 months. We have deployed quite a bit of money in the private sector banks, primarily because we believe that while the GDP forecast as of now remains at 6.5% odd number at the median, but the 1 lakh crore rupees relief, which is going to come from the income tax side, also will find its way in helping the economy to some extent. And I think that from a conservatism perspective, maybe the forecasts are not building in that benefit, which should also help. So we are a little optimistic. We would say 6.8 or 7% is what the GDP should be, and if that is the case, then the credit growth cycle should also pick up, because most of the companies which we are meeting, which we are talking, and which we are seeing, even if you see the IPO, a lot of IPOs are coming for working capital. A lot of companies are in hunt for working capital. I think that will slowly shift back to the banking as a primary source of fund for the working capital, and that will also lead to some credit growth. So we are very optimistic on the credit growth side, and we believe at the current prices, the private banks do offer very good risk reward.
Optimistic on that space. Also help us understand what's your view on capex related stocks and capex proxies going ahead. Do you continue to remain constructive on those, especially post the budget announcements?
Yes, see, there are two ways why people are seeing the capex. One is that the growth of capex versus last year, what was the estimated number? I think that number, when you see, then there is not much growth. But I think that may not be only way to look at it, because finally what you have to spend this year has to be dependent or should be compared with what you have spent last year. And if you do that comparison, then there is this spend on an average last year has been around 79,000 crore. Against that, the budget or the available money in hand is 97,000 crore per month. So I think that is a substantial jump. And if the government is able to execute and spend that much money, then you will see big tailwind in the whole capex space across the board. Now, the main concern, which if you see in the budget speech also, and after that also, has been the private capex. So very interestingly, we also have an investment banking arm, and we do keep meeting a lot of companies which are coming for IPO and on a regular basis. What we have observed that most of companies have become very, very conscious on the return on equity and return on capital employed ratios. And because of that, what is happening, they are doing very selective capex. They are doing capex only where the returns are substantially higher, and the rest of the things they are more depending on importing it from other countries, or to subcontract that. And I think that is the primary reason of private capex not picking up, most of the entrepreneurs or most of the promoters have started honestly behaving like fund managers, and they are looking at the ratios more than long term what is required for their industry and the company. And I think that is the reason this mismatch and why this private capex is not going up, and the ratios, if you see the return ratios are going up.
Yeah.
Our return ratios are substantially higher than China's return ratios.
All right.
And that is very worrying in my view in long term.
All right, Sandeep, we duly note all the points that you have pointed out in terms of the capex theme playing out, but really appreciate you taking the time out and speaking with us. Thank you so much.
Thank you.
But